Hi there. If your hospitality business handles cash payments, accurate records are essential. Let's explore what HMRC expects and why.
If
Hi
you
there.
run a pub, cafe, or restaurant in the UK, you operate in one of the most heavily scrutinized sectors of the economy. Because cash still flows across your counter every day, HM Revenue and Customs classifies your business as high risk. That classification means an unannounced compliance check is always a possibility. An HMRC officer walks in and asks to see your contemporaneous end-of-day Z readings, the daily reports from your till. If you deleted them, threw them away, or simply forgot to run them, you have a serious problem. When records are missing, HMRC is legally authorized to use their best of judgment to estimate exactly how much money your business actually made. Let's say you filed a tax return declaring £200,000 in legitimate revenue. Without the daily records to back that up, HMRC can use industry averages to invent an entirely new turnover, say £300,000. Suddenly, you owe taxes on a phantom £100,000 gap. Failing to maintain airtight daily records hands HMRC a blank check to dictate your tax bill based on their estimates rather than your reality. To prevent that, you need to understand the baseline rules for keeping records. If you operate as a sole trader, the law requires you to keep your business records for at least 5 years after the January self-assessment deadline. For limited companies and VAT-registered businesses, that requirement extends to 6 full years. The most important metric in those records is your daily gross takings. HMRC expects this figure to capture every penny coming in, cash, card, and vouchers, and it must be recorded contemporaneously, meaning at the close of every single business day. Many business owners think printing the end-of-day thermal till receipt is enough, but the ink on thermal paper is physically vulnerable. It fades completely within 6 to 18 months. By the time an auditor asks to see your physical receipts from 3 years ago, you'll be handing them blank strips of paper. This physical vulnerability is exactly why the tax system is changing. In April 2026, Making Tax Digital, or MTD, for income tax takes effect for any sole trader with a gross income over £50,000. This flowchart shows the required workflow under the new rules. A physical thermal receipt is generated at the till, but instead of sitting in a shoebox, it is scanned immediately into a digital file. That file then syncs directly into a secure, cloud-based accounting ledger. Digitizing your daily takings is an unavoidable legal requirement for surviving the upcoming MTD regime. Beyond tracking total income, hospitality businesses face a unique hurdle with VAT compliance, known as the catering exclusion. Because food and drink carry different tax liabilities depending on how and where they are consumed, hospitality businesses are legally prohibited from using the standard simplified VAT apportionment schemes available to regular retailers. This diagram shows the required alternative. Your point-of-sale system must be set up to categorize VAT rates at the exact moment the customer pays. A single order must be instantly split, 0% VAT for a cold takeaway sandwich and 20% VAT for a hot coffee or an alcoholic drink. Those precise percentage splits have to be embedded directly into your daily gross takings. When you file your quarterly VAT return, HMRC expects those figures to be perfect. If an inspector suspects you are over-reporting zero-rated sales to lower your tax bill, a properly configured POS system is the only valid defense you have. The legal requirements for your till extend beyond sales to the management of staff tips. The Employment Act of 2023 requires 100% of all customer tips to be passed directly to your workers, with no administrative deductions. This comparison table breaks down how you structure those payouts. If you, the business owner, dictate how the tip pool is distributed, it triggers expensive employer national insurance contributions. But if that allocation is handled by an independent third party, known as a trunk master, those employer NICs drop to zero. Legally isolating yourself from the tip allocation process through a formal trunk system ensures compliance with the new labor laws and saves your company thousands of pounds a year in tax. While transparency saves you money on tips, a lack of transparency with your sales software will destroy your business. HMRC is actively cracking down on electronic sales suppression, or till fraud. Simply possessing software that has the capability to delete or manipulate till transactions triggers massive immediate fines. You cannot hide revenue or manipulate your EPOS data. Full transparency is mandatory, and getting caught with suppression software invites penalties of up to £50,000 per tool. When you look at these requirements individually, they might seem like minor administrative hurdles, but during an audit, these failures compound into a single, devastating tax bill. This sequence illustrates how quickly the math turns against you. An auditor disallows £10,000 in unreceipted petty cash, add a £3,000 penalty for poor records, and toss in daily fines for non-compliant software. You are instantly staring down a £15,000 tax liability. In the eyes of HMRC, poor administration is indistinguishable from tax evasion. Sloppy record-keeping easily spirals into a business-ending financial crisis. Securing your business comes down to 4 defensive steps. Scan your Z-readings digitally, configure POS VAT splits, implement an independent trunk, and integrate MTD accounting software. Keep in mind, the information in this video is for educational purposes only. It does not constitute formal tax or legal advice, and UK tax laws are always subject to change. Don't wait for an audit letter to organize your records. Protect your revenue and build your defensive shield today by contacting Atlas Tax Advisors. Call us at 07404 427 275. Email info@atlastax.co.uk or visit our website to get started. And be sure to subscribe to the channel for more crucial tax strategies.